Today I'm going to talk about my 10 tip-top tax tips for entrepreneurs to help you pay less tax. I'd argue that it's good to pay more tax. It means you're making bigger profits. But as business owners, we want to pay as little tax as legally possible. We want to make sure we claim all of the tax reliefs that are available to us and to plan our affairs to keep that tax bill down. As an accountant, this is what I help my clients do, and today I'm going to help you do the same. Now, all of my tips have three things in common. The first is that they're simple, the second is they're legal, and the third is they need a bit of thought and planning. So, what do I mean by simple? Well, most of these tips can be done by yourself, if you know about them. And they are quite straightforward, if you know about them. But they can have a big effect on your tax bill, if you know about them. Sometimes the simple things have the biggest effect. For example, it's only quite recently I found out you can double click on a word on your computer and it highlights the whole word. Or triple click and highlight the whole paragraph. But over the years, how many seconds, minutes and hours have I spent dragging my mouse left, right and centre to try to actually highlight the correct words or paragraph to copy and paste something. If only somebody told me this years ago. And the embarrassing thing is that when I mentioned it to my wife, she said, "Everyone knows that, John." But the point is that I didn't know, and it's the same with some of these tax tips. I'd expect everyone to know some of them, but very few to know all of them. So there should be something here for every business owner. The second thing is that they're all legal. Someone actually said to me recently that, to be honest, I don't like to take advantage of tax breaks because you're opening yourself up to investigation. You might save a few £100, but cost you thousands of pounds in an investigation. Now, every one of these tax breaks is 100% legal and above board. They all just use HMRC's guidelines, and some are actively encouraged by HMRC. There are no dodgy offshore transactions or loopholes in contracts here. They're all nice and straightforward and legal. So what about the planning? There's only so much we can do after your year end has passed. Many of these tips need to be planned before your year end. Sitting down before that year end with your accountant can save you loads more tax. So what are my top tax tips for business owners? Here we go. My first tip-top tax tip for business owners is a really simple one. It's one that a lot of people will be doing already, but not everyone is doing correctly. The first tip is to make sure you take the money out of your business in a tax efficient way as possible. Now, these tips are mainly aimed at owners of limited companies, and if you are the owner of a limited company, the way you do this is by paying yourself a small tax efficient salary and taking the rest of your money as dividends. What do I mean by a small tax efficient salary? Well, you should pay yourself a salary up to the national insurance threshold. Currently that's £9,500. Now, if you pay yourself up to this threshold, the company will save corporation tax at 19% of that £9,500, but you receive it in your pocket, tax-free and national insurance free. And that's the key here, it's national insurance free. If you go above that threshold, your company still gets saved 90% of corporation tax, but you personally pay national insurance at 12% and the company pays it at 13.8%. Therefore, you're saving 90% in corporation tax, but paying 25.8% in national insurance, which just doesn't work. If you pay up to the threshold, the company does pay a small amount of employers' NI, so the threshold for that's a bit lower, but the net saving is just over £1,700. And don't worry, you do still get all your contribution towards your state pension. If you earn more than the lower earnings limit, which is just over £6,000 each year, you get all of the benefits, but without paying national insurance yourself. Any additional money you take out after your salary, you take out as dividends. Dividends have to be taken after accounting for corporation tax, so you can only take dividends up to the level of the profits in your company after that tax. Dividends are a tax-efficient way of taking money out of the business. You get your first £2,000 of dividends tax-free every year. As a basic rate taxpayer, you then pay tax at 7.5% on dividends, rising to 32.5% if you're a higher rate taxpayer, i.e. earning more than £50,000. This then rises to 38.1% when you earn over £150,000. Overall, though, dividends are usually cheaper than salary in tax terms. So this is how, as a director, you take your money out of the business. Did you know you can pay a family member as well as yourself? The The first person you might look to is your partner. If your husband or wife doesn't work, you might want to pay them the same tax-efficient salary as I talked through in tip 1. That could save another £1,700 of tax in the business while they receive the cash tax-free. Now, they should be doing something for that, something you can justify paying them a salary for. For example, it could be helping out on the admin. The next step would be to make them a shareholder, because they can get an annual £2,000 dividend allowance tax-free and also benefit from the lower tax rates as well. The rates change slightly every year, but to give you an idea of the effect, if one person solely owns a business that makes £100,000 of profit, they'll pay about £31,000 in total tax bill across all the taxes. But if 2 people own that company jointly, the total tax bill is under £20,000. That's more than £11,000 cut off your tax bill. So it's well worth doing. Did you know you can actually pay your children a salary as well? Now, I was asked a little while ago how old somebody has to be to have a salary, and I will admit I didn't know the answer. However, I was pretty sure my client who was asking couldn't put the 6-month-old baby on the payroll. Now, it turns out they could in certain professions, things like acting or modelling. However, generally speaking, children have to be aged 13 or above to have a part-time job. Now, this can work really well. Perhaps at university and be given the money anyway. You might want to actually get them to do some work for you at the weekends or in the summers and pay them a salary to get tax relief from the company. However, you do need to be careful. To be allowable, the salary should be realistic, not excessive, and must actually be paid to them. You can also give your children shares in your company. Now, if they are under the age of 18, it's actually the parents get taxed on these dividends, so there isn't actually any benefit. But if they're over the age of 18, they can benefit from the tax-free allowance and also the lower tax rates. There are 3 types of gifts you can give. The first is to clients, the second to your staff, and the third is the best of all, gifts to yourself. You can give any gifts you want to clients and customers, but you only get tax relief if they meet a few criteria. The gift cannot be worth more than £50. There's also a limit of £50 per customer per year. The gift must have your company name on it in a conspicuous way, and unfortunately can't include alcohol, food, tobacco or vouchers. So my clients get something much better than alcohol. They get a brand new John Davis pen and notebook, and it is eligible for tax relief. For the staff, it's slightly more relaxed than for clients. Again, you can spend up to £50 per staff member on gifts each year. But for staff members, it doesn't need to have the company logo on, and the good news is you can give them food, tobacco or alcohol. The only exception is cash or vouchers. These aren't eligible for tax relief. Best of all, what about gifts for yourself? If you're the director of a company, you can buy yourself gifts. The limit on these is basically the same as for staff gifts. Each gift can't be worth more than £50 and can't be cash or vouchers. But you can spend up to £300 per year on gifts and claim tax relief. And if you follow tip 2 and keep it all in the family, you can actually do the same for any family members who are employees of your company. So you can spend up to £300 on each of them as well. Now, it's worth noting that client entertaining is not eligible for tax relief and you can't claim VAT on it either. However, staff entertaining is eligible for tax relief and you can claim that VAT. Now, how much can you spend on each staff member? You can spend up to £150 per head on staff entertaining and claim the tax and VAT back. And that £150 can include extras like taxis to and from the venue or a hotel bill after the event. This is an annual limit and it doesn't have to be spent in one go. However, each event is assessed individually, and if an event goes over that £150 limit, the event is no longer eligible. As an example, if you have one event worth £150, you do get tax relief. But if you have one event in the year worth £151, the whole event is not eligible for tax relief. It's all or nothing. If you do more than one event and, for example, the first 2 events cost £70 each, they're each eligible and use £140 of the limit. If the third event costs more than £10, none of the costs of that third event is eligible. The first 2 are still okay. The other condition to be aware of is that for these events to be eligible for tax relief, everybody needs to be invited, or at least everybody needs to be invited in sensible groups. So if you're split across different offices or different departments, it could be an event for each of those offices or departments. But you can't just pick and choose your favourites. It has to be all or nothing. Now it's worth noting as well, if you're a sole trader or the only owner of a limited company, you can still reward yourself with a Christmas meal. And because the rules are actually £150 per person, you can take your other half and get to use up to £300 tax-free. So what tax-free benefits are available to you and your employees? There are many tax-free benefits you can pay for that get tax relief from the company and no tax on the employee. These include the following: medical checkups, annual health assessments, mobile phones, relocation expenses if you need to move from home, providing workplace nurseries and creches, sports and recreational facilities, car parking at the office. You can subsidise bus or rail fares or provide company bikes. There's also that £150 per person per year for staff parties. Another tax-free benefit you can provide is relevant life insurance. Now, relevant life insurance is a defined term, not just life insurance you think is relevant to you. It's a type of insurance for directors and owners of a business that can get tax relief. It's be a really good way of rewarding your staff and yourself. My sixth tip is to use loan agreements and understand the consequences for taking loans for your business and potentially making late repayments. So, what do you need to know about taking a loan from your company? If you do take a loan from the company has to pay tax at 32.5% at its year end. The company pays this as part of its corporation tax return, and it's basically done to stop you taking the money tax-free and running off and never repaying it. That 32.5% is repayable by HMRC when you repay the loan, because the idea is that when you do repay the loan, you've probably taken the money out as a dividend that's been taxed elsewhere. Now, sometimes it could be worth actually taking a loan out rather than taking a dividend. This is relevant if you're paying tax on your dividends at 38.1%, i.e. if you're an additional rate taxpayer earning more than £150,000 per year. In this case, the loan is actually cheaper than a dividend. What do you need to know about lending money to the company? If you lend money to your business, as is often the case when you first set up your company, you can actually charge interest on that loan. The interest does need to be at a commercial or a market rate, but there can be a tax benefit. The company can claim tax relief on the interest paid, but you might receive the interest tax-free. A basic rate taxpayer can earn up to £1,000 each year tax-free in interest. A high rate taxpayer can earn up to £500 tax-free. However, there isn't any tax-free allowance for additional rate taxpayers. Basically, putting money into a pension is one of the most tax-efficient things you can do, and it's investing in your future. You can put up to £40,000 each year into a pension and get tax relief. If you haven't used your allowance in the past 3 years, you can carry this forward as long as you did have a pension in place. The £40,000 limit is reduced if you earn over £150,000. You lose £1 of tax-free allowance for each £2 you earn over that threshold, until the limit is reduced to a £10,000 allowance. This happens if you earn £210,000 or more. There's also a lifetime allowance of £1.055 million for tax relief. However, if you stick to these allowances, paying into a pension is a really wise and tax-efficient thing to do. My eighth tax tip is all about commercial buildings. And to really save your tax, I'm going to mix it with my seventh tax tip on pensions. One of the most tax-efficient things you can do is to invest money into a pension. But to boost this even more, you can put your money into a self-invested personal pension known as a SIP. A SIP can buy a commercial property, for example a property for your business to rent. Your business then pays rent to the landlord, i.e. your pension. The business claims tax relief on the rent, but your pension receives that rent tax-free, up to the annual pension allowance of £40,000. The other bonus of this is that one day in the future when you sell the building, any profit you make on selling that building is received by your pension tax-free. So, using a SIPP to buy commercial property is a really wise thing to do. Even if you're letting it out to other people, it's still a good thing to do because they're paying into your pension tax-free, and one day you'll sell the building for a tax-free profit. The slight barrier to doing this for many people is actually having a pension big enough to buy the building. The rule is that you can take out a mortgage on a building bought by a pension, but the mortgage could be a maximum of 1/3 of the value of the building. So as an example, if you want to buy a building worth £300,000, you need to have £200,000 in the pension because you can only borrow £100,000. So get saving into that pension now. R&D can conjure up an image of laboratories and people in white coats, but it doesn't have to be like that. So what is research and development? R&D is when you develop something innovative and new. This can be a new product, but could also be a new system or process, a way of making things quicker or better within your business or for others. So what's the effect? If you have developed a new product, system or service, you may be eligible to claim research and development credits. If you claim these credits, you can increase the tax relief you receive on the expenditure. The way this works is that for every £1 you spend, you get £2.30 deducted in your corporation tax return from your taxable profits. What this actually means is it increases your tax relief by nearly 25%. To give you an example, if you spent £100,000 on a standard expense, you reduce your tax bill by £19,000, i.e. 19%. However, if you spent £100,000 on expenses that could be deemed as research and development, you reduce your tax bill by £43,700, which is 19% of £230,000. That's an extra £24,700 knocked off your tax bill, so it really is well worth doing. Now you should be aware there are a lot of criteria you need to fill in to be able to claim research and development credits. It can be a little bit technical, but it's something a lot of people are eligible for but don't know about. It's also worth checking as it can have a huge effect on your tax bill. And it's something HMRC actually wants to give you, as the government is incentivising you to innovate. So please do look at it. My last tip is all about timing. It brings together some of the other tips, but I want to stress how deadlines and timing can have a big impact on your tax bill. It's why planning is so important. So why is timing important? Well, if you own a limited company, you pay tax on the profits based on the year in which they're earned. And in some cases, you get the chance to decide when they are earned. As an example, if you're going to make a large purchase, it's better to make it the day before your year end than the day after. This is because you get the tax relief a whole year earlier. We actually had that the other year when a new client came to us because they were upset over the tax bill. They bought 3 vans for about £50,000. The year end was the 31st December and they bought them in the first week of January. If they bought them 1 week earlier in the last week of December, they'd have got exactly the same tax relief, around £10,000. They would have got it a whole year earlier, and that would have made a big difference on the cash flow. So that's the first thing about timing. The second is on dividends. If taking money out of the company's dividends, then you, as the owner, can decide when you take out that dividend. For example, you take the dividend out on the 5th of April, it's in a different tax year than if you take out the dividend on the 6th of April. Again, you can delay the tax bill by a year by taking the dividend 1 day later. But you also get a chance to look at the different thresholds and the effect that might have. As an example, if you're paying dividend tax at 7.5% of the basic rate taxpayer and have used up all of that 7.5% band by early March, you'd pay tax at 32.5% on the next dividend. So you might wait until April to do it. Conversely, if you haven't used all of your allowance, you might pull your dividends forward to get them into that year. Because once your allowance is gone for the year, it's gone. You also need to look at some of the other important thresholds that reset on the 6th of April every year. The first is your £2,000 tax-free dividend allowance. The next is when you become a higher rate taxpayer at £50,000. And £50,000 is also the point at which you start to lose any child benefit. When you hit £60,000, all of that child benefit is gone. So it might be worth capping yourself at £49,999 to keep that child benefit. The next big threshold is when you hit £100,000 because you start to lose your personal allowance as well. And the last one is that £150,000 mark where dividend tax goes up to 38.1% and you also start to lose your annual pension allowance. Therefore, think in advance about the time of when you spend money and when you take money from your business can have a massive impact on your tax bill. So, those are my 10 tip-top tax tips for entrepreneurs. As I said at the start, they're all quite simple. They're all legal. What does bring them together is they need a bit of planning. So, my big recommendation to you is to actually do that, to plan. Speak to your accountant. They can do a lot for you after the end of the year. They can do so much more if you speak to them before your accounting year ends, preferably with a couple of months of notice. Some leaves can be claimed later, but some need to be used up by the year-end deadlines. And if you're thinking of closing or selling your business, you can save a lot of tax by planning this a couple of years in advance. And that one definitely deserves its own detailed explanation in another video. Hope you found the top 10 tax tips useful, and I'll use some of them to cut your tax bill. If you would like more tips on tax, accounts and business, please subscribe to our YouTube channel, and I'll see you soon.